What if I told you that some of the absolute best investing advice for today's crazy market wasn't cooked up in some quant fund yesterday, but was actually written down in a letter more than 30 years ago? Well, today we're getting a masterclass from the master himself, Warren Buffett, by diving into his incredible 1989 letter to shareholders. And right there, at the very heart of this letter, is this one sentence that just explains, well, everything. Buffett says, "Time is the friend of the wonderful business, the enemy of the mediocre." Honestly, that single idea, it's the key to so much of his success, and it's the big theme we're going to unpack together. So that's our mission. We're going to pull apart this amazing document and extract 4 huge lessons that are just as powerful today, maybe even more so, than they were back in 1989. Think of it as a private coaching session with the Oracle of Omaha himself. All right, first up, lesson 1. And it's all about focusing on what he calls the only number that counts. See, right from the get-go in this letter, Buffett tells us to basically ignore the one number that almost everyone else in the financial world is totally obsessed with. He says what really matters isn't book value, the number on the balance sheet. No, it's something way more important. He calls intrinsic value. And he defines it as the only logical way to figure out what a business is worth. It's pretty simple, actually. You just estimate all the cash that business is ever going to produce and pull it back to what it would be worth in today's dollars. And the difference here is it's everything. Book value is history. It's what the accountants say it's worth based on what already happened. It's like looking in the rearview mirror. But intrinsic value, that's about the future. It's about what the business is actually worth going forward. Just getting your head around that one shift in focus is a total game changer. Which leads us perfectly into lesson 2 because it builds on this whole long-term idea. Buffett calls it the Rip Van Winkle edge. And yeah, it's about the incredible, almost unbelievable power of doing almost nothing at all. So in the letter, he lays out this fantastic little thought experiment. Just picture 2 people. First, you've got the frenzied investor. Starts with $1, it doubles, he sells, pays his taxes on the profit, and then does that same thing over and over again for 20 years. Then you've got the patient investor. She also starts with $1. It also doubles 20 times over 20 years, but she only sells 1 time, right at the very end. So, after 2 decades of all that buying and selling, our frenzied investor turns his $1 into a pretty respectable $25,250. Not too shabby, right? But what about the patient investor, the one who just sat on her hands and waited? Well, her dollar grows to a mind-blowing $692,000. I mean, look at that difference. It's just, wow. And this is where the genius of it hits you. The only thing that's different between them is when they pay taxes. That's it. By waiting, the patient investor let the magic of compounding run wild without the tax man taking a cut every single year. It's not about genius stock picks. It's about having the patience to let the math do the heavy lifting for you. Okay, so we've learned to find intrinsic value and to be super patient. Lesson 3 is all about the flip side, what to run away from. So get ready for some classic, sharp-weighted Buffett as he teaches us how to spot financial folly. In the letter, Buffett really goes after the kind of creative accounting that was getting popular. He singles out this one metric he calls EBIDIT. That's earnings before depreciation, interest, and taxes. And his opinion on it? He literally calls it delusional. His logic is just pure common sense. He says ignoring depreciation, the cost of things wearing out, is insane. As he puts it, even a high school dropout knows when you buy a car, you gotta plan for the fact that it's losing value. Pretending that cost isn't real just because you're not paying cash for it at that exact moment, that's just living in a financial fantasy land. He actually links this kind of fuzzy math to this really interesting idea called the bezel. It's basically the total amount of theft in the system that hasn't been discovered yet. For a little while, the thief feels richer, and the victim doesn't feel any poorer. It creates this temporary illusion of wealth that feels great, but it's guaranteed to come crashing down. So, Buffett gives us this brilliant, simple test to see if a deal is legit. If some promoter is pitching you with all sorts of weird accounting, just suggest they take their fees in the same funny money way. And then, as Buffett says, see then how much enthusiasm for the deal endures. It is a perfect way to call their bluff. And that takes us to our final lesson. And this one might be the most powerful because it's so personal. It's about Buffett admitting to a huge mistake he made over and over again early in his career. He calls it the cigar butt mistake.
So he describes his early strategy as finding a cigar butt on the sidewalk. You know, a gross, thrown away company that was so dirt cheap you could pick it up, get one last free puff of profit out of it, and then toss it. But, as he straight up admits in the letter, he learned that this was a terrible idea. Why? Because when a business is bad, there's always another problem right around the corner. He puts it in this unforgettable way. Never is there just one cockroach in the kitchen. It's such a great warning about so-called value traps, things that look cheap but are actually just junk. And learning this lesson the hard way led to probably the single biggest shift in his entire investing life. He went from his old way, buying a fair company at a wonderful price, to his new mantra that we all know today, buying a wonderful company at a fair price. The quality of the business suddenly became the most important thing.
So, after taking this trip back in time, after sitting in on this 30-year-old masterclass, what are the big lessons we should take away that are still so incredibly relevant? Well, it really boils down to this. 1. Focus on what a business is actually worth, its intrinsic value, not just what the accountants say. 2. Let your winners ride. That Rip Van Winkle patience gives you a massive mathematical advantage. 3. Always be on the lookout for financial tricks that try to hide real costs. And 4, remember that it's so much better to buy a great business at a fair price than a fair business at a great price. Really, it's all about sticking to what he calls simple one-foot hurdles that you can easily step over. And that kind of leaves us with one big question to think about. In our world of constant noise, algorithms, and just overwhelming complexity, is it possible that this kind of simple, patient, rational thinking isn't outdated at all, but is actually the ultimate and most lasting advantage you can have?